It's a weak report relative to expectations, but it's not a terrible number. 223,000 is pretty good. I mean, the trend growth in the labor force is about 150,000. So if we keep getting 200 plus payrolls, we get a steady improvement in the unemployment rate. The unemployment rate dropped for the wrong reasons, as you guys noted. It dropped because the participation rate fell. So that's a little disappointing. And then wages were flat, which is a pretty disappointing number there. So I'd say, 2 out of 3 are bad here.
One report of any stripe, an employment report, an ISM report, a construction report, doesn't move the Fed's thinking materially in one direction or the other. They work in trends. They work on the medium-term horizon. And in that regard, the jobs report is part and parcel of what we've had lately. Mediocre to slightly better than recently job growth, and that keeps the Fed in play.
I don't believe there's contagion risk. I don't believe there's economic risk. However, there is headline psychological risk, and we could see a sell-off. The simple fact is that, the market's expensive. We've got Fed phobia, and maybe that's an offset. But the simple fact is, if you look at the price-to-sales ratio over the last 20 years, we're trading at probably 25% premium to that. Doesn't mean that the market has to drop 25%, but what it suggests to me is even if we get a pullback, unless it's severe, I would not view it as a buying opportunity for investors, certainly traders. But for those investors that have a 3, 4, 5-year time horizon, there are probably cheaper values to come sometime between now and then.